My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Bill Brewster, who, if you are not familiar with his Morning Brew podcast, I highly encourage you to check it out, as well as Lead Lag Live. Bill, for those who are not familiar with who you are, talk about your background. How'd you get interested in markets? Why do the podcast? And why are you so into the Buffett and Munger way of thinking about investing?
Well, thank you for having me, first and foremost. So I guess that I got into investing because I was born into a family that has some wealth, and there weren't a whole lot of people, unfortunately, that care about that. I think some people tend to think that the money came from trees, and I needed some sort of mentor. And I have my grandma's friend had built a company, and I've known him since I was a kid, and he sent me 3 books. He was actually friends with John Bogle, and 2 of them were Bogle books, and one of them was The Intelligent Investor. And, I don't know, I think I probably should have just read the Bogle books and gone that route, but something about The Intelligent Investor kind of like caught. I thought it was smart, which is aptly named, right? So that led me to Buffett, and then I started to just study those guys and the way that they think, and I think that the way that they communicate really resonated with me. And it's funny. I think a lot of the things that I thought I understood that they said, now I have a completely different interpretation when I listen to it. But I guess, like everything, as you get a little more informed, you realize there's a lot more nuance than maybe you thought when you didn't know much. I came to Twitter because I left a bank. I had an uncle that died a pretty tragic death, and it was very sudden. And I had to figure out how to manage money in case something happened to my grandma quickly. And I left. I had got my CFA, and I've been to law school. And my wife said, look, it's more important for you to figure out how to manage money and stick with a strategy than to stay. I was at BMO Harris underwriting commercial credit, the senior loans. And she said, you can always go back to the bank. But I kind of pitched her on this, but then it was my words coming out of her mouth. And she was like, you can always go back to the bank or a bank, but you should probably focus your energy on something that can, have a higher payoff for our family. So, and more important than that, I had seen my mom sell at the bottom of 2009. So I wanted to make sure that whatever strategy I implemented, even if it's theoretically suboptimal, it's one that I can stick to in downturns. So I came to Twitter to not get lost in the world. I figured, how am I going to at least broadcast what I'm doing? And in the beginning, it was I mostly pasted transcripts that I thought, screenshots of transcripts that I thought were interesting. And then my buddy Toby Carlisle asked me if I wanted to do a podcast with him. And that was moderately successful and remains so. That's called Value After Hours with Toby and Jake Taylor. And then I was sort of in an unfortunate incident where my wife's cousin was the Robin Hood trader that killed himself. And I found myself in the middle of a news whirlwind. And I think that sort of amplified my attention on Twitter, which I still kind of struggle with internally. And then, some time had passed, and I've always wanted to do long form interviews. I said in the beginning, I wanted it to be more like Howard Stern, because I want to, a lot of podcasts I feel like are sort of promotional, right? And I understand people are going on them for marketing, but there's a lot of stuff that happens in life that's not all gravy. And to the extent that I can get people to open up and talk a little bit about their hardship Not that they have to come on and cry or anything like that, but it's nice to hear people talk about what some of the costs, right? Like Moses Kagan came on, and like an hour and 20 minutes in, he starts talking about his divorce and kind of what building his business that he currently has had cost him. And I think it's easy for a lot of people to look at him and say, here's a guy, he's GP at this real estate firm and he's got everything and whatever. And I like that he let people see a little bit. There was a lot of grind and a lot of tears and some pain behind what he got. Because sometimes I think you listen to podcasts and it's like everything I do is roses and I'm the smartest. And, I just like to shed a little bit of light behind that. So I've been really fortunate to get very high quality guests. I think people have been really open and, we'll see how long I keep the business brew going. It's been a fun project, but I do it mostly selfishly, I learn a lot. But it's one of these like give to get type mentalities. And I think it's a real win-win. And I think in the beginning, I talked a little bit too much and I made it a little too personal. So I think if you listen to the evolution, I talk a lot less now, which you may not understand if you just listen to this space. But I typically try to be like 15% of the conversation or less. Because I feel like the guests are more interesting than I am at this stage.
So I was watching the YouTube interview you did with William Green, who I had on one of these spaces not too long ago, and there's a point in the conversation where you talk about your grandmother and you get choked up in talking about it, and I have so much respect for being willing to be vulnerable, right? Because I often find that the only way you can really get to know somebody is you have to show some emotion, you have to express vulnerability so that you get it back. And that's the only way you can really not only develop a relationship, but also get to a more sincere place. I think to your point, a lot of podcasts are really just quasi infomercials, right? Whereas if you really want to get to the truth and really understand how somebody thinks, not only as a host, you have to ask the right questions, which we'll get into, but you have to show that you as the host can be vulnerable so that they are also open to be vulnerable themselves.
Yeah, I think that's true. And like William went down his path of horrors after on that podcast, and I was really appreciative that he would do that because the first time I met him at Berkshire, I almost missed my flight. I went up to him. It was the Sunday at the Markel lunch, and I said, "Mr. Green, I saw your coffee table book. I love what you did. Do you mind grabbing lunch?" And he sat down and he and I talked. I don't know. I think we talked for like 3 hours and 15 minutes. And I looked down at my watch and I was just like, oh my God, I'm going to miss my flight. But he went through his whole career. And, for him to be able to share some of that on the podcast again, like here's a guy that was on top of the world in his 30s and then turns around and he's laid off. And, I think that would be quite shocking to many. And, to see what he's turned it into, obviously he's highly talented, right? It was just very cool to be able to do that with him. And as far as my grandma, thank you for noticing that. She's the OG in my life, probably the only reason I'm half sane. So I'm down here taking care of her until ultimately she passes away.
So you had you mentioned that you were born into wealth, right? And which is why you're a private investor and obviously had a successful career in other parts of the finance industry. But when you look at studies on wealth transference across generations, it doesn't look too good, right? I pulled up a stat here, around 70% of wealthy families lose their wealth by the second generation, and then something like 90% by the third generation. Do you find that it's harder to keep wealth when you've grown up with some wealth, right? Because we're all victims of our own experiences. I say victims purposely, right? Because that's what shapes our decision making.
Yeah, I mean, look, I if you ask me what cards I want at birth, I'd rather take it than not. I would say that my dad and his brothers grew up a life that was insane. I was actually just talking to my dad the other night about it, and I think an unfortunate reality that as I've gotten older, I've realized is as much as my grandma meant to me, they had like servants and stuff. And my dad had his own house when he was 16, and he had like a beer tap. And I, I have an uncle that died. He died of cirrhosis of the liver at 42. I have another uncle that the one that died tragically. He had a lot of issues in his life, and he finally had gotten his life together. And then he was working on a car, and he was on a hill, and he didn't put a block in front of the tire, and it rolled down the hill and caught his jeans and dragged him, and that was that. So I think I used to resent my dad and his brothers a lot because they didn't like. My dad always cared about working, but he didn't really understand like money that well. And I always thought, like, how can you come from so much and know so little about this and not really teach me anything? And I guess I kind of attributed it to laziness a little bit, and now I attribute it a little bit more to neglect. And I don't. I'm not going to owe poor me being born into a wealthy family. Like, that's insanity. But I do think that at times, wealth can create a scenario where parents are not around, and the number one focus in my life is my three kids, and I'm going to make sure that they have parents that are around. I've also seen 5 divorces between my mom and dad, so I have a strong goal of staying married to my wife. And then, I think it's my duty to reverse the negative wealth trend in my family and start to compound again. And, then it's on them to figure out what to do next, them being my kids.
Yeah, no, right. I mean, at some point there has to be a conscious effort to stop a cycle, right? And I've seen that myself, with my own parents as well, and how it's, as I've gotten older, that's made me push back, looking back at things that I would disagree with in the way they approached various things, and it takes a conscious effort, which is in self awareness, obviously, in doing that. Now, you said you're a CFA charter holder. I don't see the CFA after your name, which I'm surprised by, because a lot of people, including myself, are, you can say, proud of having the CFA charter. And although on Twitter it tends to be vilified because it's, sort of the old Wall Street idea.
My only beef with them is that I'm one of these guys that kind of wants to pull up the ladder, man. I think that one test a year, get in there, see if you can do it, and if you can't, I don't know why we're doing all these tests, but whatever.
Yeah, no, I know, and it's interesting because you talk about compounding, and obviously part of compounding is not just your investment portfolio, but compounding your knowledge. And investing is a curious domain in life because it doesn't matter how smart you are or how knowledgeable you are, nobody can predict the future. So I get the cynicism around those that have CFA charters, because there's this presumption that they know more about what's going to happen next than somebody who doesn't have a CFA charter. To me, it's been much more a process of proving that I'm a hard worker, right? Because it's a very long grind to get those 3 exams, to do the studying. It doesn't say anything about my ability to manage money or anybody's ability to manage money, because there's a lot of factors outside of your control. But I don't think that means that you should just totally disregard what having the charter tells somebody about that person.
100%, man. And I did it while I was working at the bank. I mean, I didn't sleep for like 4 years, basically. And I don't know, I don't know if that held back my career at the bank or not, but I'm glad I did it. I value that program very much. I don't have it behind my name for the same reasons I don't have JD. I don't really want people to impute knowledge on me based on some letters after my name. I'd rather have the ideas speak for themselves, which unfortunately some of them have spoken pretty poorly over the past 12 months. But we'll get back on track here. And I guess the other thing is, it's hard for me to know. I've studied Munger enough to know that, like, people impute authority on people, and I'm not out here marketing anything other than a podcast and probably some events someday. And I am very, very cognizant of the fact that everyone that follows me is not a professional investor. And I don't want retail following me into something because I have a lot of followers or I have some letters after my name or some stuff I say like sounds smart. So I just try to, I'm not, look, if I was applying for a job, I definitely have it on my resume, right? But I just don't, it's just not my thing to broadcast here.
So I know you're as you mentioned, you know Tobias Carlisle quite a bit, quite well, and I've interacted with him quite a few times trying to actually do some business with him on a side note. And I'm a big fan of the way that he approaches the value side of investing. But value, as you know, can be like everything else, subjective. Right? Some people will use certain metrics to define value. Some people will consider it based on a chart. I'm curious in terms of your own thought process, given the people that you've talked to, given your own self studies. How do you define what value is in your world?
This is a constant debate that Toby and I have. I think that one of the things that's tough about value is like if we just think about something that's really tangible, right? Like real estate. When I look around at the assets that I think have done well on a sleep adjusted basis, I don't think buying property in the slums at a 15 cap when it should have been a 12 cap has proven to be the best sleep adjusted return.
By the way, I love that term, sleep adjusted. That's phenomenal.
Yeah, I mean, I just think I think if you're managing like your own capital, right? And actually, I don't even mean it that way, because if I ran outside capital, I think I'd be even more neurotic, which is part of why I don't do it.
That's why I have lumbering gold eyes and look ridiculous on Twitter, because I am neurotic running out the people's money.
Yeah. So, it's just like beachfront property has given people a real return regardless of almost anything that they bought it for. Now, is this a late cycle interest rates go down for 30 years comment? Possibly, right? Like there must be a limit to what you pay for very rare assets. But my entire life, all I have seen is true scarcity accrue value. So, in my own life, we in September of 2020 bought one of the last plots of land that's on this waterway here where I live. And, did I get some crazy discount to what the market was? No. But I knew for a fact that there were only like 5 lots left. And once you don't get any, like once those sell, good luck buying a plot of land on the river. And, we got an unsolicited bid for twice what we paid 6 months later. So I kind of define value as, you got to pay a fair price. I mean, ask anybody from 2021 what overpaying does. But I think that there's probably 2 ways to approach it. And actually, Scott Reardon, my last episode that came out, I think is a great conversation. And he did a study of the best investors ever. And it basically comes down to 2 camps is what he found. You've got like the deep value guys and girls, or you've got like the people that focus on these high quality assets. And, maybe it usually trades at somewhere between a 3 and a 6% free cash flow yield, and occasionally gets to 7, and they go in and that's when they swing. And then they've got to be right on the business, right? But I think there's a couple ways to play the game, and I don't define it statistically anymore.
I like the true part that you referenced, true scarcity, because I put that tweet a while back, but we went from analog scarcity to digital scarcity, and now back to analog scarcity with oil and natural gas. Is it fair to say that the crypto space isn't really true scarcity?
I have no idea, man. You're gonna get people. I just don't have I'll tell you what. I think crypto, to me, reminds me of what I saw in 1999. It reminds me of an idea that I don't know how it's going to change the world. I do know that there are a lot of smart people that I talk to, one of which is in here, like Thomas Brazil. That dude, I have immense respect for. And he tells me that they're a very real crypto project. So I'm not going to like shit on crypto until I can have an informed opinion and out debate him on that particular subject. But do I think that there's like a lot of fraud and nonsense in it? Yeah, 100%. And do I think that we're way early in an adoption curve? Yeah, I do. But in 20 years, might we be talking about some crypto projects that change things? Yeah, I think that's possible.
So I often rant against certain narratives in the crypto space, but I also want to see the space arguably do well, but not for the wrong reasons. The wrong reasons being a false sense of confidence that it's going to take over the world tomorrow, which means leverage the hell out of it today. Right? That's more
Yeah,
my
and
perspective on it.
like on Twitter, right? I wish one of the things I wish people would do, and I should hold myself accountable to this, but sometimes I feel like I don't know how to be so precise with my probabilities. But it would be nice if people, when they're table pounding, said like, "I am 85% confident in this prediction," right? And then if you want to make it even harder, put a time limit on it, right? But like Bitcoin's going to change the world doesn't really tell anybody anything, right? It's like, okay, how much of your portfolio's allocated to it? How confident are you in the bet? And what's the time horizon that you think it's going to happen in? Like those are much more nuanced conversations that I think get lost often.
Okay, so let's go to the name of the space, which is asking the right questions, because for years I myself have been on the other side as somebody being interviewed on CNBC and Bloomberg when I was doing the media runs and Real Vision and so on and so forth. And as I started doing these spaces when Twitter released it, I think it was late November last year, it was a learning process to flip the table and be able to ask questions and listen thoughtfully and try to figure out directions in the conversation to go. Um, talk to me a little bit about how you got to be as good of an interviewer as you are now, because it's not a natural skill, I find.
Oh, well, thank you for the compliment. I appreciate it very much. I listened to a lot of Howard Stern, a lot, and I think that what I learned from him is you have to be present in a conversation. Like I'm not talking about, when he's got the shock jock stuff. I'm talking about when he gets like real legit interviews going. There's this element of preparation plus really listening and being present with a person and asking, it's just listening for that thread of the conversation. Sometimes I listen to what I ask and I'm like, I really messed that up. But it's hard in real time. So I think I'm probably, I don't know, 65 to 75% of what I want to be eventually. But I think that, when you're fortunate enough to be talking to a guy like Chris Cerrone from Acri Capital, it's way more important to listen to what he's saying and try to stay with his thought process than for me to bring my thought process to that conversation. Because I mean, now I can call him, but at that time I only had like 2 hours of his time, right? So it's like, I got to be a sponge. It's not about what I think, and that's just how I try to approach it.
But it's also challenging, right, to be fresh with the content, because listen, the truth is, if you're interviewing people that are in this game of investing, you can probably ask the same 10 questions, and the answers will all be different, but they're still the same 10 questions, because there's not that much you can argue in terms of creativity, right, for what you're going to ask somebody, right? So how do you think about that part of it? Because I do a space pretty much every day with different guests. Most of them are in the investment side. I think I do a decent job of trying to make every topic unique and interesting and ask different types of questions, but it is hard as hell to do that.
Dude, I'm impressed with how you get your booking done. Like, I have mad props for you for even getting that many spaces scheduled. I don't know. I mean, I don't have a great answer for this, which is part of why the podcast is on a pause right now. I've got a couple episodes that are lined up that I think are going to be good. But I've what I've taken the approach of recently is I don't want to get caught up on the content trap and the rat race of having to drop an episode every week. And I am fearful a little bit that is going to cause some people to churn. I think that risk is somewhat mitigated by the fact that I think that the real people that are fans of the show, if I dedicate it to quality, when they see it show up in their feed, they're going to listen. and that's kind of the tactic that I'm going to take. But I don't have a great answer for doing it all the time, because, to be honest, between, value after hours and then doing a podcast a week, I kind of get burnt out of finance conversations. Like, I'm interested in a lot of other stuff in life too, right? And I don't know. I'm thinking about doing another show where I get into stuff like parenting, and I said on my last podcast, I'm going through a middle-age crisis, and it's manifesting itself into apathy. I wouldn't mind pulling on that thread a little bit, but I can't do it in a finance show. So I might do like another show, and then whenever I interview a finance person, drop it in both feeds. But I don't have. I wish I had a better answer for you. I'd have a more consistent show.
Well, but what's interesting? So I've also often wrestled with this debate about quality versus quantity when it comes to content. And look, admittedly, I do it because partially it's content marketing. I've got other business interests as well that I try to put out there. But I find that the challenge is that because people's attention spans are increasingly getting shorter, that I think the unfortunate reality is that in the battle of quality versus quantity is winning out more, just because people don't seem to want to stick around and listen necessarily, or pay attention to much more thoughtful conversations or long form type of material. I'm curious how you think about attention spans, right? Because you've got to hook somebody pretty early, but in a world where you got snaps and vines that are 6 seconds, and all kinds of studies that show that people tend to only focus for 6 seconds or 7 seconds, and that's it. It's hard to really focus on just quality alone if people are not going to stick around to see how good that quality is.
Yeah, I am 80% confident you don't want to be caught in the middle. I think that people actually have quite long attention spans when given the chance. I also think they have very short attention spans, but I don't think they have middle attention spans. So my theory with the podcast is, if I can get somebody talking for an hour and 30 minutes plus, there is going to be an insight, hopefully more than one, but definitely one, that they otherwise would not have shared if we had a standard 60-minute format. And I think that thesis has proven pretty true, because there's only so much that you can do in an infomercial, and then like the real you comes out in a conversation. So, I probably should be better at hiring somebody that can go through the clips and maybe do YouTube shorts to drive sort of awareness to those parts of the conversation. But I don't want to like hoe my audience out like that. And I think that, in a 90-minute conversation, a lot of the people that have come on have come back to me and said, like, I really enjoyed that. Right. And it, there's like meaningful moments. And I kind of think that the guest deserves to be listened to. And if that means that the show doesn't do big numbers or whatever, I think I'm pretty okay with that. But that said, it does piss me off when certain episodes don't land like I think they should.
I'm always amazed by the how far off my predictability is on people that show up on the spaces, right? Like the audience number. I mean, I'm very pleasantly surprised with the number of people that are attending, at 5 Eastern on Friday into a long weekend, right, for this conversation. I mean, it shows you that I forget who it was, but somebody once said something along the lines of, people focus too much on having the perfect tweet or the perfect post that they are hoping to go viral, but the reality is nobody knows what's going to go viral, so you've got to keep putting stuff out there and hopefully get lucky.
Yeah, well, I'm friends with Dan McMurtry, and he and I talk about this a lot. Like, he was better at Twitter, I think, when he was anonymous, because he had more freedom. But now, he was like, dude, I have no clue. Like, I'll send out some tweet that I think is junk and the world loves it, and then I'll have like what I think is the most insightful thing ever, and it'll get 3 likes. And I found something similar in that regard.
Yeah, it's remarkable. It's like my pinned tweet, which, at least in my world, is the most important and frustrating dynamic of this year is, in my opinion, and yeah, I'm biased, one of the most important data points that prove that this year is an anomaly. This interaction of stocks to treasuries and high volatility that we've never seen appear like this before in history beyond all these stats around stocks and bonds and 60-40, yet it doesn't get anywhere near as much attention as me saying that inflation is a bigger threat to democracy than any politician, which is a reference to the Weimar Republic, right? So it is interesting that you never really quite know how that come up here. Bill, with the different
wait, real quick, before we move on that 60-40 thing, who had an early interview on that was Consuelo Mack. And I mean, I guess in retrospect, I should have table pounded a little bit, but they said something smart where the person being interviewed was like, look, when you look at like the valuations of equities and where bonds are trading, the probability that 60-40 works from here, like he said, long short's the new 60-40. And when he said it, I was like, that's a smart take. And I think that probably, is theoretically correct. I personally have no idea how to manage a short book. So it's not something that I've done, even though I should have shorted the shit out of Robinhood like I told you I should have. But, that's the only one that kind of grinds my gears that I didn't get right.
By the way, on a side note, so if you were to do a correlation on long short HFRI index against, let's say, the select sector spider ETFs, long short on average tends to correlate almost exactly to XLP, the consumer staples ETF. So interestingly enough, on the 60-40 discussion, maybe it's not about long short, rather maybe it's about risk and then utilities, staples, healthcare, kind of the defensive sectors as the new 40, which really is the case this year because while bonds have sold off, the bond-like proxies within the equity market have been the clear winners outside of energy.
Yeah, well, I've seen a lot of tweets about like, why does Coca-Cola trade at a similar multiple as Google or whatever? And it's like, well, on a forward-looking basis, advertising could drop off a cliff. And Coca-Cola, if you think inflation ever goes down, there's some probability out there that their margins explode because they're not taking price down after this. So, it's kind of interesting. I think your staples comment is something I see people, I'm sorry that I'm tangential on this, but something I see people comment on a lot is they're like, well, consumer spending is staying strong. If you look historically, consumer spending is pretty resilient. It's the shift within consumer spending that's the issue. Because to your point, in tough times, you got to buy your staples. They tend to just chew up more of the spend, but the spend is relatively stable, at least from the data that I've seen.
Right. And if you do a very simple spread analysis and look at the rolling outperformance of consumer staples against consumer discretionary, you get to a similar risk on, risk off, signal as using utilities as a leading indicator, or lumber and gold, which I reference a lot because of the link to housing, which is only now starting to enter its own bear market. Which, on a side note, I'm a deep believer in this idea that the bear market in stocks won't end until the bear market in housing ends, and that's still pretty early, which is why we may be in this kind of prolonged period of max frustration for both generations that are involved in markets.
Yeah, the thing that's tough on, at least the thing that I believe is tough on housing, is I do think that I need to know exactly how big the investor base in housing is, but I do think we have a fundamental inventory issue here, at least short term. So it's like one of those things that if builders slow, it's definitely not great for the economy, right? Because the multiplier effect. But what happens to price is a harder question for me. But then again, you would think eventually people start to default, but then you got like credits are, the credit profile of the borrower is as good as it's been, and it's fixed debt. So I don't know. It's a complicated environment to look at, in my opinion.
Right, and it goes back to the name of the space, which is why you have to keep on asking questions to try to really see what's happening beneath the surface. Is there any guest that you've had on who really surprised you that made you really think in a very different way? Where after the conversation you said to yourself, "Wow, that really made me. That's going to be life altering, right? In the way that something's framed."
Life altering guest is like Arnold Vandenberg. That guy's just. He's one of a kind, and his story is incredibly inspirational. I I guess that I don't know how to answer this because I've had a lot that I've really enjoyed. I have a guest that sticks out to me where when I was pitching, I'm sorry if you hear children and a dog in the background. It's this is my life. Um, I had a discussion with David Barr, and it was right around when I was pitching Curate, and he said something in the middle of the conversation where he was like, you know, you just got to make sure that you sell re-rating plays when they hit fair value. And when I had underwritten that idea, I thought, you know, a reasonably strong fair value estimate was like $10, and it got to 12. And I think you have like, it's important to update as the facts change, right? And I would not have underwritten the environment being as good as it was for as long as it was with Curate, but I think I let myself get a little bit too attached to what the current outlook was. And one of the lessons that I've taken from that is, for those that don't know Curate, it's QVC and HSN. Um, the strategic position for them was very, very challenged when supply chains got more complicated. And the way that their programming works is like you've got this one today's special value, and then you've got like a couple shoulder products, but the one item of the day is what really moves the needle. And supply chain messed up when they can schedule all that stuff. And I was looking at historically how consistent the business had been, but I missed how fragile supply chain issues could make the entire formula work. And then on top of that, you know, they had a big fire and whatnot. But I overstayed my welcome, and I think of David a lot. I think of that conversation a lot. I wish that I had listened to that comment.
Let's talk about the regret of not shorting Robinhood for a moment. Talk through that, because I think a lot of people fall for the trap of regret, and regret from a behavioral finance perspective is known to be the most powerful emotion, which obviously is related to hindsight bias. But talk about why that was so frustrating for you.
Well, I mean, I just, that company's such a piece of shit. And
tell me how you really feel, please.
Yeah.
Let's go.
Mean, you know, and you know, the way that they treated my cousin was so fucked up. I mean, that kid, he wrote 3 emails to them that said, I don't know how I can possibly owe this money. I don't have a margin account. Like, I only had, you know, $28,000. You're showing me a negative $700,000 balance. 3 emails. Now, I understand that he was a novice trader and was shown something that, you know, I guess that the number that he was shown is something that is not unusual for people that trade options. But if you are a hyper growth finance company, you got to know that you're not, I mean, it's not like you're attracting professionals to the organization in droves, right? Like, you're by definition attracting novices. And then the amount of, or the lack of customer service, and the fact that they didn't get back to him just like drove me nuts. And then the outpouring of people that wrote me just horrific stories about, you know, how their accounts had been handled, and the amount of money that they had lost because of the lack of customer service. I mean, I got to give a shout out to Mark Cahotis. He was giving me fuel that week because I know he knows how to run PR campaigns. I reached out to him, and I'm you know, I'm grateful to him for doing that for me. He was kind of in the background a little bit, but I told him, I was like, this fucking company is DraftKings. It just happens to be, you know, it's a casino that is a financial, you know, it's masquerading as fintech. But, you know, there's a couple things I would say that it's probably better that I don't have an attachment to them for my psychological well-being. But man, I don't know, like some of the VCs that were involved, and when I think about, you know, their returns and how they were made, and the fact that there aren't asterisks next to those track records, I don't know, it still pisses me off a little.
No, and of course that's 1,000% justified. I often struggle with this question of whether democratization and ease of access is a good thing or a bad thing, because on the one hand you want to have people involved in markets investing because you have to compound and try to create wealth, but on the other hand, if you attract people that, to your point, are novices and you don't teach them and you're not attentive to them and explain that risk matters, it ends up being damaging despite their own efforts because they don't know what they don't know. So there is this, I would argue, fiduciary responsibility among platforms to make sure that those that are using those platforms know what they're doing, at least somewhat, in terms of managing risk and knowing some of these nuances of how losses and gains are even reported.
Yeah, I had Christy Ross on the pod, and she is co-CEO of, or was, of Thinkorswim. I don't know what iteration of their company, or I guess Tasty Trade was Thinkorswim, and I don't know what they're currently called because they've been through a lot of acquisitions. But ironically, one of the things that got me into investing again was options trading because I was in Chicago and Thinkorswim was located there, and they always led with education, which is what I respect about that firm and the way that they do their business. And I look, I'm not like crazy about people getting introduced to options trading as an idea. I don't think I still have a lot of reservations about that, but every time I called them, they picked up the phone within the second ring and somebody would walk me through a trade. They have white papers on option strategies. Like I think that they handle the responsibility that they're asking for in the right way. And I don't think it should be regulated away. Right. So though I may not want my kids to do it, I understand that there's a place for it. What was really upsetting about Robinhood was just it just reminds me so much of like this Silicon Valley, my perception of the Silicon Valley ethos of go fast and break things, and everything that goes wrong is an externality. And, we got limited liability and we got options and we'll make money and who cares? And I just think when you do that with people's money, it's really fucked up.
When I travel the country and I do presentations at CFA chapters, I will always say to the audience, the best thing for most investors to do is go with the broker that has the highest per share commission, that has the highest costs. And I always get a little chuckle from people in the audience, but we know that there's a temptation to overtrade when you have no commissions and when you've gamified investing and made it look like it's free. And the problem, of course, there is that we know from a lot of studies that overtrading is usually the number one reason why most people underperform the benchmarks from a buy and hold perspective. So there's this temptation to overtrade and actually ends up being quite damaging. I would argue that people have better longer term returns in mutual funds than ETFs for the exact same reason, because when the price is updating once a day with mutual funds or second by second in the case of ETFs, there's a temptation when it's second by second to do the wrong move.
Yeah, I mean, on a personal level, I just moved my assets to a bank, and I have no idea what my login information is, and it's somewhat for this reason. Like I just don't want to see it anymore. I know what I own, and I know how to change it, but I was not getting any benefit out of having it, at my fingertips all the time. So I agree. There's also studies that don't people in load funds do better than people in no load funds, which is like totally counterintuitive.
100% right. Which, by the way, and that goes to your point about what you said earlier in the conversation, which is learning to stick to a strategy. I've used that line many times. Your ability to stick to a strategy matters more than the strategy itself. And to the extent that there's some kind of reason for forced sticking to a strategy, you're better off, which tends to be, to your point, the load fund, the exiting, all that stuff.
Yeah, I think it's interesting. I was talking to somebody on the other night about private investments, and I've come up with this thing where I used to think like the illiquidity premium was so stupid, and now I kind of think of it. I know it doesn't make sense from like a theoretical standpoint, but part of me wonders if the behavioral advantages of illiquidity in the real world exceed the negative benefits of not being able to get out, or the negative cost. right?
Yeah, no,
So
I
maybe
spot on.
there's a
Yeah.
reason why that premium is actually not irrational.
Yeah, no, that makes a hell of a lot of sense. It's just interesting to me that, and then of course the question is like, who do you blame for that, right? Because on the one hand, the customers, they want that frictionless way of getting in and out of the market, but on the other hand, they don't want to self educate to be able to know that that frictionless getting in and out of the market actually is probably the worst thing for their longer term wealth generation.
Yeah, I mean, I think I was on Jim O'Shaughnessy's pod, and we talked about Robinhood, and I have mad love for him because he's friends with some of those VCs, and he still put that episode out. I've got mad love for him for other reasons too, but I thought that was very courageous of him. And we talked about a lot of this. I think a lot of these questions are very difficult to answer, like a lot of life. But I do know that there are some things that are easy to answer. And one of those things is you should provide customer service to people that are trading options.
Yeah, no, completely agree with that. Okay, so going back to, again, the name of the space, asking the right questions. Again, everybody here, make sure you follow Bill and check out the Business Brew. So asking the right questions is not just something you do in interviewing others, but it's also something one does when there's some self-reflection, right? You've got to ask yourself, what went wrong. Is it a decision you would have made again? And I think it applies to more than just investing. That's a lot of aspects of life. But I'm curious, given your own investments, just like everybody else, I'm sure you've gone through drawdowns, you've had mistakes in your investing career. How do you think about self-reflection? How do you ask yourself the right questions?
Well, I think the right question right now is why do I even try to pick single securities when there's a lot of other ways to go about things? And the answer is that I feel like it does give me some purpose in life. I'm not sure that's the correct answer, but it is the answer. Um, I journal. I should be more uh, consistent with it, but I find whenever I write, I tend to be. It tends to help me sharpen where I actually need to reflect. And I made I made a lot of the same mistakes that a lot of other people did. But one thing that I uh, did well is that I never got myself hyper concentrated. I thank God didn't bail on Papa Buffett. Um, and I even though I kind of say that I don't necessarily believe in the traditional school of value, I still had a decent amount of value. So from a factor perspective, I had some things that saved me from some of the catastrophic results that some people look like they're going through. So we'll see how it all goes down the road. But I think it's an interesting game because there's this delicate balance between taking a position and saying more than everybody else, and then also recognizing how humbling the market is. But I think that the best I've got the Charlie Munger that speech, The Psychology of Human Misjudgment. That's like one of my checklist items. I got to go through all those biases, and even if I have them, I got to like write down to myself, this is my bias, and I know that I'm suffering from this. But uh, I don't know how else to do it other than to be aware and to try to at least state out loud, I may have a weakness here.
That, by the way, I mean, that's consistent with a lot of, as you know, behavioral finance studies that show that you can be aware of a bias, you can be aware of a heuristic. It doesn't mean that you can stop yourself from being biased or avoiding the heuristic. So that it's a very, I think self-awareness is one thing, but it really is hard to actually change, one's way of looking at the world, even though they're aware that it may not be the right way of looking at the world.
Yeah, I totally agree. And I've had things where I've known that something it was like there's been the voice inside my head that's like, this is the red flag, and I've blown right past it, right? It makes no sense. But I'm human, so I just try to minimize those amount of times.
What's something in the industry that really, really bothers you? I know you mentioned VCs a bit on our back and
Well,
forth on.
yeah, I mean, I don't know, man. I think I have a lot of love for this industry, and I think it gets a bad rap. I just think I guess that I kind of wish that in retrospect, some of the pixie dust that was floated to the market by certain people, and I'm thinking of one prominent promoter. It's that's what's wrong, and it would be nice to see some version of justice come to that. But I think that that's probably going to happen at the top of every cycle, and it's a shame. But I just am hopeful that the remaining active managers out there are the ones that think of fiduciaries or think of themselves as fiduciaries, and that people understand what that word means, because it's very, very important. And scummers don't really belong here. They don't deserve to be.
That's so. You mentioned you came to Twitter to self-educate and be a part of the community, but in relation to what you just said, I'd argue Twitter can be quite toxic, because there's obviously a lot of that kind of nonsense that you see, and a lot of people liking and retweeting things that not only are intuitively wrong, but I would actually argue are borderline illegal in the way that things are framed and the way that it manipulates price action. You see a lot of that with the crypto space, obviously, with some of these shit coins and the kind of things that pump and dump, but it happens in the public markets too.
Yeah, and I think it's I think it's unfortunate how big certain accounts are. When I think that they're just like Momo trading or
Present company excluded. Present.
Yeah, or
Okay,
revising history. I just try to be honest, where I say, like, look, to the extent the account's big, Twitter's somewhat of a popularity contest, but that doesn't mean you should listen. You should probably follow the smaller accounts for the real insights. But I don't know. Guys like Clark Street Value, I'd read that before I'd read my Twitter feed all day long.
Yeah, no, I'm in agreement with that. Obviously, even though I have an incentive to not agree given the size of my own account, but you're right. I mean, I think, and I always make that point too. It's like you should think about following, liking, and retweeting people that you also don't agree with, right? Because if we go with the fundamental premise that nobody can predict the future, then that means that everything when it comes to investing is ultimately an opinion.
Yeah, that's right. And it's there's all kinds of behavioral problems, right? It's like you see something that you don't agree with, so then then the studies say what it actually hammers in what your previous thought was, and people will say something and then other people want to argue with it, and I fall into the same trap. But if anybody needs my advice on how to use Twitter, I would just argue that de-escalating usually is a great idea. And so I got trolled on this one episode that I did with George Labatis. I hope I'm pronouncing that right. And who was it? It was Ebit Daddy. They said like, I enjoyed the parts that George talked, and I remember I was like kind of pissed off. And then I went back and I listened to it, and I said, they really have a point. Like, I dominated that conversation, and George had things that were way more interesting to say. And I need to change how I'm doing things. And I think that, like, listening to anger and or elation, right? Emotions, like putting a pin in it and saying, okay, what is that actually telling me? Is an effective tool.
Yeah, no, I agree. And I am curious, Bill. I mean, I'm sure you probably thought of this in the past, but is there anybody that you really wish you could interview who is not around anymore? Somebody that was particularly interesting in your studies around investing or anything like that, that it's like, if you had the chance because they were around alive, you'd love to interview that person. Who would that person be?
Bogle would be cool.
Bogle, for sure. Yeah.
Yeah. I mean, like, talking to him about what it was like getting it started, whether or not people laughed at the idea, like really going through that. I think that would be a cool interview. So easy to see the behemoth that is without appreciating how much hard work was done on the front side.
Yeah, no, very, very well said. Everybody here, again, please make sure you follow Bill Brewster and check out his podcast, The Business Pro. I am sincere when I say that I've listened to a few of his conversations, and I'll be upfront. I actually look up to you and took notes in terms of how you interview others, because I'm trying to myself every day improve, and it's not an easy game. I was joking. I only need to do 10,000 more spaces to get good enough to be in the Gladwell camp of being an expert, right? The 10,000 hours kind of thing.
Yeah, your hours. Yeah.
Right. So I'm getting there at this
You'll
point.
have it done by next week.
Right. At this rate, exactly. So listen, everybody, again, I appreciate those that were here. I'll have another space tomorrow, Sunday, Monday, because what the hell else am I going to do on Twitter? Bill, real pleasure. I'm glad we did this. I appreciate your candor, your knowledge. I think integrity and having again, that point about vulnerability is really lacking, not just in FinTwit, on Twitter in general, but just in society. It's okay to be open and talk about things that might be, from a self-reflection perspective, hurtful. But again, you don't really get to know somebody unless you are vulnerable. So I appreciate you being here and talking about some of your own personal history as well.
Yeah, man, I had a lot of fun. Thanks for doing this.
Thank you, everybody. Have a good weekend.
All right. Take care.